Since the Foreign Company Accountability Act in 2020, Chinese stocks listed in the U.S. have shrunk by about 1.6 trillion. As we entered 2022, the SEC's pending delisting of 5 Chinese companies has raised questions about the prospects of U.S.-listed Chinese stocks. China's zero-COVID policy amid the current outbreak in Shanghai and Shenzhen, the country's 2 major financial centers, and the Russian invasion of Ukraine with possible U.S. sanctions against China for assisting Russia, have all cast doubts on the Chinese economy and triggered a foreign capital outflow. All eyes are on the next investment move by Li Ka-Shing, the richest man in Hong Kong, as he liquidates his major European assets. Hello everyone, I'm Lei. Welcome to Lei's Real Talk. According to the Hurun report, Li Ka-Shing ranked number 30 on the global rich list as of 2019. But before I tell you his story, let's take a look at the Chinese financial markets. Chinese stocks are not doing well, whether they are listed in mainland China, Hong Kong, or the U.S. stock markets. The NASDAQ China Golden Dragon Index has fallen 72% from its peak, which is equivalent to the market decline during the 2008 financial crisis. Alibaba alone lost about $500 billion in value, the largest loss of shareholder wealth in the world. The share prices of some U.S.-listed Chinese stocks have plummeted. Real estate transaction platform company Fangduoduo's price fell to below $1. Online education company Gaotu fell from an all-time high of $149 to $2. Chinese rideshare company Didi has fallen from the $14 IPO price to below $4. The risk of Chinese companies being delisted in the U.S. is increasing. Earlier in March, the SEC disclosed that 5 Chinese companies were at risk of being delisted for failing to comply with audit requirements. In addition, the Wall Street Journal reported that SEC is launching a full investigation into the Big 4 accounting firms to see if their practices have weakened their ability to conduct independent reviews of the financial condition of listed companies. Not only have U.S.-listed Chinese stocks plunged, the Hong Kong Hang Seng Index, dragged down by Chinese stocks, has shed a quarter of its market value in the past 12 months, reaching a new low in 6 years. However, what worries investors most is the geopolitical risk posed by China's alliance with Russia, which increases the likelihood of further deterioration in U.S.-China relations and secondary sanctions. Data shows that foreign investors are accelerating their dumping of Chinese securities. The Wall Street Journal reported that foreign investors have unloaded $9.5 billion worth of mainland Chinese stocks in the first 3 weeks of March. The highest daily net outflow occurred on March 15th, when a net 16 billion yuan or $2.6 billion of foreign investments left the Chinese stock market, the 3rd highest outflow in history. The United States, the United Kingdom, and the European Union have jointly frozen the assets of about 29 Russian tycoons, which is about $1.4 trillion. Coupled with the devaluation of the ruble and the plunge of the Russian stock market, the net worth of the richest Russians have evaporated by 1/3 per the Bloomberg Billionaires Index. This is certainly on the mind of Chinese tycoons. On March 11th, Hong Kong's richest man, Li Ka-Shing, sold UBS Group's London headquarters building for £720 million cash. In addition, Bloomberg reported that Li would also sell their UK Power Networks, the largest electricity distribution company in the UK, and telecom operator 3UK. UK Power Networks is priced at £15 billion. Li bought it 12 years ago in 2010 for £5.8 billion. According to the Financial Times, the Li family once controlled about a quarter of the UK electricity distribution market, nearly 30% of the natural gas supply, almost 7% of the water supply, more than 40% of the telecommunication market, and nearly 30% of the docks, as well as more than 500,000 square meters of land resources. The Chinese Communist Party, or CCP, has been using Hong Kong capital and capitalists as a signboard to invest in strategic projects worldwide, and Li, as the richest man in Hong Kong, couldn't escape the fate of playing a role in the CCP's global expansion. For the past decade, Li's investments mainly focused on Europe, Canada, and Australia, in communications, power, ports, natural gas pipelines, and other strategic projects. Back in 2001, the Heritage Foundation warned about Li's company, Hutchison Ports' relationship with the CCP's military and Beijing's influence in the Western Hemisphere. Li played a crucial role in bringing Huawei and 5G to Britain. Among those British telecom providers that jumped to support Huawei, 3UK and the network part of O2 were owned by Li. It was believed that he had influence over Vodafone and EE. Bloomberg broke the news in April 2019 that Vodafone actually discovered Huawei equipment's backdoor as early as 2011. Li's 3UK announced a £2 billion collaboration with Huawei to build 5G networks across the UK in 2019. However, after the COVID pandemic broke out, telecom companies have been banned from buying Huawei 5G equipment, and the British government ordered all Huawei equipment to be removed from its 5G network by the end of 2027. In addition to economic expansion, Li's resources in global ports are also valued by the CCP. As early as 1997, Hutchison Ports acquired the right to operate two major ports for 25 years on the Panama Canal. Last year, the lease was renewed until 2047. The company has invested heavily in development near the ports. Hutchison Port Holdings owns 169 berths in 41 ports worldwide, controlling dozens of potential economic choke points. And the state-owned China Resources Group, which has close ties to the Chinese military, owns 10% of Hutchison. In May 2020, Hutchison Water bid $1.5 billion to construct the world's largest desalination plant in Israel. If successful, Li's company would control nearly a quarter of Israel's water industry. Desalination is a key project in Beijing's Made in China 2025 program, and the plant is located near an Air Force base and a nuclear research facility. Li's bid alarmed the U.S. government. After strong opposition from Israel's defense minister and emergency intervention by then U.S. Secretary of State Mike Pompeo, the bid from Hutchison was unsuccessful. Being one of the most astute Chinese businessmen, Li Ka-Shing's business moves have always been of great interest to market analysts. In the context of the escalating conflict between the West and China, Li's sales of important assets in the UK is likely related to the sanctions imposed by the West on Russian tycoons. Mainland Chinese media have been beating the drums to cheer Li's divestments in the West and possible return to China. In 2018, the media extensively reported on the British Archive's declassified Li Ka-Shing file. According to the released information, Lord Derwent, then managing director of Hutchison Europe, said in 1987 that Li Ka-Shing was violently anti-communist. Still, he said that Li was also an absolute realist who maintained excellent relations and worked closely with senior party leaders. After having dealt with the CCP for over 40 years, I wonder what Li really thinks of the CCP right now. Mainland Chinese media reported that Li is interested in China's energy sector. We shall see what his next moves are. I've made a couple of videos on Chinese billionaires. Being a billionaire in China can be one of the most dangerous jobs. You can check out their stories. That's all for today. Thank you very much. See you next time.